This is Enrich Your Life, a podcast about financial health, life planning, and smart decisions with Richard Limegruber.
Let's pivot a little to CLOs, or collateralized loan obligations. I know those are a little different, but how are CLOs structured and what type of loans typically make up the underlying pool of investments?
Sure. So what I've been describing is just like private credit loans in general. And one of the biggest investors in private credit loans is CLOs. The way to think about CLOs is just, it's like a specialized bank. And so like if you bought stock in, say, a JP Morgan or Bank of America today, I mean, they're in 30 different business lines or something. But a CLO is just, think of it as like a simplified bank that's its one business line is lending. So each CLO might be about 500 million in assets. The assets are a diversified portfolio of first lien loans. And then that pool is financed with long-term debt that's like non-mark to market, a debt sold to banks and insurance companies around the world. And then we invest at FlyRock in CLO equity and junior CLO securities. And basically investing in CLO equity is like being the equity in a bank. So you get the profits that are created from earning a return on the assets higher than your financing cost. Just that. And then when you're in the equity, when the loans default, that's the risk you're taking.
Right.
And then the CLO debt securities, they're rated, they're sold in different portions. They're like rated AAA down to BB. And we also have a fund that invests in CLO BBs. And the way to think about that is it's just a debt security backed by this diversified pool of loans. You're kind of junior in your right to repayment. So there's, the AAA ahead of you down to the BBB. The loans have a 30 plus year track record of solid performance. And that's resulted in CLO BB rated notes having a default rate of about 25 basis points over the last 30 years.
That's incredible.
It is. So that's one of
Sorry, go ahead.
Yeah. So if you compare that to like owning loans directly or to high yield has basically a 3% default rate per year. The loans have 3% depending on which kind of like loan index you're looking at. And so this is like, less than a tenth of the default rate of high yield bonds or loans.
So if you wanted to just give a quick difference between investing in a CLO versus investing directly in a corporate bond, or a lot of my clients might have a corporate bond fund, what would you think the biggest difference is between the two of them? Well,
Sure.
So even comparison, I'm not even sure.
Well, one of the differences, if we're talking, so the CLO is issuing both debt and equity. So there's, two different kind of perspectives to share there. But basically for the CLO's debt, the historical experience is that the returns are better than doing corporates directly, and the risk is less. So you get both. There's a few reasons, but like one of the primary ones is that you and I could agree today to lend money to a company that we like the private equity firm that backs the company. We think its prospects for revenue growth and profitability growth are outstanding. But there's always, these unknowns, and there could be regulatory change or technological change or management turnover. And we could be in a position where the loan is at risk of default, right? And so that happens, and that's the business I work in. But for CLO securities, it's a different way of kind of viewing the world. So I'm dealing more with, like, when I buy CLO equity, for example, there's no like loans that I'm betting on. I'm not saying, oh, this, loan X, the Assurion loan needs to do well for me to do well on my investment. Like that's not how it works. So I'm dealing with, kind of default probabilities. So I look at a pool of loans and say, if 2% of the loans in this CLO default each year and the recovery is around 70 cents, then if I own the equity, I might end up with like a double-digit return. So in that example, like I'm the bank and I have these high yielding loans. And if my projected loss rate comes in where I expect, then I'm going to make a nice equity-like return. So that's how CLO equity is working. And then if you invest in CLO BBs or higher up the stack, it's like a different way of doing the world. The BB, you don't really care if the default rate is 1% or 2% or 3%, you just get your money back in all those cases. If you own CLO double B notes, like I said, historically the default rate is de minimis, but you're really just on the hook if, by the way we model them, it's like you basically need a default rate that's like 2x the financial crisis, and you need to be there for 8 or 9 years for you to impair one of these CLO double Bs. So you're just like, that's your risk is kind of like really like a downturn that would be unprecedented. And if CLO double Bs start defaulting, then certainly they'll be underperforming, but any other asset class that might have been interesting to you would be in much, much worse condition. So the CLO double B benefits from the initial equity that's contributed to the CLO. That's who is on the hook for the primary loss on the loans.
Great. And so these type of investments that we've been discussing so far, the ideal investor would be high net worth individuals, institutions. What would you recommend for somebody looking to potentially buy these investment strategies?
Sure. So CLO securities are sold to lots of different types of investors. So the top part of the stack, if you will, are CLO securities rated AAA, and maybe I'll include AA and single A in there as well. Those are sold to banks around the world. Here in the US, the big money center banks buy these securities. And for them, the attraction of buying CLO debt securities is that on the one hand, the interest income that they'll receive from the CLO AAA is much lower than what they would receive if they own the loans directly. However, owning the loans directly, the loans are rated single B, and they're buying something rated AAA. And so if you're a bank, what you really care about is your return on equity. And so the regulators require very little capital for the AAA and a lot of capital for a single B loan. And so part of the private credit story that we didn't really touch on is just that the lending to these private equity backed firms has gone from banks, it used to be banks 20 plus years ago, to now it's, private credit funds, it's CLOs, and banks aren't making these loans. They're investing in the top part of the CLO capital structure. They're getting exposure to loans, but they'd prefer other people to take kind of the first loss risk on the CLO portfolio. So that's kind of the top rated CLO securities. For CLO securities rated, call it triple B and double B, and double B is like pretty much the lowest rated security. Those are sold to like asset managers, funds like myself around the world as well. And there, the interest rates are higher and the risk is higher. And so like that's for somebody who, I think buying CLO AAA is about preserving capital. I don't think you get very rich buying CLO AAAs. But in the double B and triple B, there's guys like myself who are trying to earn favorable return for shareholders and trying to really kind of make the end investors' money grow. And that's like where we specialize. And then in CLO equity, which is a different strategy, people allocate to that kind of in lieu of private equity or the S&P 500. So CLO equity is going to be more volatile than CLO debt securities. And if you're buying equity, you're going for these double-digit returns, and you need to be willing to, or just know ahead of time that there can be and will be some volatility in the share price, and it won't be a straight line to get you to the double-digit returns. But in our opinion, if you hold the CLO equity for its full life, then that's very likely where you'll end up.
Yeah. And so that leads me to my next question. So thank you so much for all this information. What is the typical time frame that somebody should expect to have to hold on to these, like a full market cycle? I know we always say you never want to invest in something unless you have 7+ years of liquidity. What would you recommend is that holding frame for somebody looking to invest something like this?
So for the underlying loans, so just like private credit loans in general, so they're going to have, call it a 6-year maturity, but the loans are prepayable at par, really at any time after like 6 months to a year. And so the loans never really go to the final maturity. In fact, if they did, that would probably be like a company that's going to default, right? Any CFO with like a 6-year term loan is going to want to refinance it at a minimum at kind of year 4. They're not going to take it to the 6-year maturity and B, trying to like negotiate a document a couple of days ahead of when the money's due. That wouldn't be a smart thing to do. Private credit market is generally open, but in times of, market stress or recessionary risks, there could be times where you get stuck. So the loans generally repay in like 3 to 4 years. And so you're getting the interest income every year, and you're getting like the loan payments kind of every 3 to 4 years. Loans are just refinancing. They're refinancing, or they're companies being acquired, or they're doing some other like fundamental change in their business that results in you getting repaid. And so you have this like natural amount of cash that just kind of flows into the fund. And that, by the way, is one of the reasons that these securities work in interval funds. It's that private equity a private equity strategy, in my opinion, doesn't work in an interval fund because you'd have to do these 5% quarterly tenders, but you don't have any inflows from your assets. So I don't know how you do that. You could set aside
New money, right?
cash or new money. Well, that works as long as it's coming in. But an attraction of private credit is you're getting a lot of cash flow over time. You're not I guess in our business, like the jargon that people use is the J curve, where like what that means in private equity is that you become a member in a private equity fund on day one, and you have capital called from you, and there's no return of capital, for could be like 5 years. And then after that, more payments come in. But in private credit, it's like totally different. There's not like a J curve. Like you're getting, when you lend money to a company, like their first interest payment comes to you like 90 days later, like you're earning the income, right? And then for CLOs, it's a little different. A CLO begins its life with what's called a 2-year non-call period. And that means like the CLO will be outstanding for 2 years. So that's kind of the minimum amount of time it could go. And then how long it could go depends on like a number of factors, but anywhere from end of the non-call period plus another 4 to 5 years. So 6 to 7 years, it would be kind of the typical CLO life cycle.
Okay. And so anybody who's looking to invest in these, are there any emerging risks or any new opportunities that you're keeping a close eye on right about now?
The two securities, again, that we focus on are CLO double Bs and equity. And for double Bs, I mean, at the time that we're recording this, we got through Liberation Day, and it seems like a lot of the tariffs have been rolled back. Markets are starting to calm, but kind of like the new risk emerging is just our budget deficit, which is continuously like not addressed, or gets worse, right? And so from the perspective of a CLO double B investor, I mentioned this 30-year track record of de minimis defaults. Well, in that 30 years, there were a lot of downturns, really significant ones, like GFC being, COVID, GFC, the telecom tech bust of the beginning of the 2000s. And so these double Bs, through those strong tests or strong challenges in the market, survived and did fine, right? So what I think we're seeing today is I think risks are higher than we came into the year for loan defaults, but they're not at a risk where people who own CLO double Bs should be concerned. So that's my view. And also, that seems to be the market's view. So CLO double Bs trade around par today. So nobody's selling them at a discount thinking the risk is up. They just trade around par. And then for CLO equity is down this year. And the reason is that I think it's two things. One, recessionary risks are certainly higher than when we came into the year. If you have more loan defaults, that's the risk you run as a CLO equity investor. So CLO equity is down for that reason. And then, of the, call it 3,000 loans that we provide exposure to in our funds, some of them are going to be affected by tariffs. I mean, some of them are going to have supply chains that have issues, and these are, companies that are levered. And they're also companies that are not as big as like an Apple. They can't go to the White House and meet with our president directly. So there will be higher defaults as a result of tariffs and just kind of the economic uncertainty that's created. And so CLO equity has traded down this year, not substantially so, but we see that as an opportunity. CLO equity is cheaper. maybe a good entry point, for folks. They need to do a fair amount of work there to get comfortable. CLO equity is at a discount today, whereas like other asset classes really have fully recovered from the tariff risks.
Yeah, great. Yeah, we always talk about investing when there's opportunity. And I think ultimately this is the opportunity for CLO investing, as you mentioned. So, always look forward to finding out new information for our listeners. I guess the last question I'll have for you is, what are some of the resources or educational materials that you would recommend for listeners who want to learn more about this?
There's a couple resources. In my role at BlackRock, I get to and enjoy do a lot of CLO education. So I've been in the market for 20 years. And fortunately, during that time, I was with firms that saw a fair amount of firms that had good returns and therefore saw a lot of growth in our funds, and got to be one of the larger investors in kind of the securities that we target. And so in a little bit after COVID, I wrote a 60-page white paper and we put it on our website, and it was just, how I go about investing in CLOs. And I was really surprised by how many people read it. CLO bankers read it, CLO managers. I think some of my competitors may have read it as well. And and
so
so
you're doing the right thing, right?
exactly. So that gave me the idea to write a full book. And the book is 220 pages. It's up on Amazon, and it's written for somebody who has, oh, thank you. That's it. It's for somebody who has some financial expertise and background, but that does not know anything about private credit or CLO. So it starts from the very, very beginning. And I found that actually a lot of the material in the book was stuff that I had just, was created over time. I didn't sit down and just start writing what's a CLO from scratch. Like we've been doing a lot of this education at BlackRock for a long time. And then, so I published a book, and I think that's, a great resource. And then 6 months ago, I started a podcast. So it's called the CLO Investor. And what I'm doing there is I'm not like, really not really pitching our funds. Actually, it's just like an educational thing I'm doing where every like 3 weeks or so, I have somebody from a prominent person from my market come on and talk about what's happening in the market. And it's people from CLO researchers at banks, CLO bankers, traders, CLO managers. I just try to have somebody interesting on, and I actually use it maybe similar to how you partially use your podcast. Is for my own education. So whatever's interesting to me, I have that, I reach out and find a guest who wants to talk about it. And like some of the podcasts that people have found, helpful to them are ones where at BlackRock, we're not an investor we're not a CLO manager. So we buy these securities issued by the CLO, but there's a third party CLO manager that's underwriting the loans and keeping the CLO passing its tests. And for us, that's guys like, again, like a BlackRock, New Mountain, Jefferies, Barings, some of the big publicly traded alternative asset managers. And so when investors want updates from me on our funds and fund performance, they can hear it. I can provide that information, but sometimes it's really interesting to get the perspective of the CLO manager themselves, of the person who's kind of in the trenches on these loans. And so the podcast is like one way where people can get that kind of that perspective. It's called The CLO Investor with Shiloh Bates. It's easy to find on Apple or Spotify or wherever people use podcasts.
Well, you got yourself a new subscriber today because we signed up for it. So you'll see Enrich Life Podcast as one of your subscribers.
Great.
So, we'll continue to listen and learn. And of course, obviously, like you said, I do want to learn more. And I want my listeners to learn. And I have always said, I've been in business for 26 years. I wish the people that come to me to explain their products can just talk to my clients, because you definitely have a better story to tell. You have a lot more knowledge about it than when I have. But that's why I started doing these podcasts, because I would love to share the insights from the professionals like you that I get to hear from on a regular basis. Well, and last but not least, how can listeners learn more about BlackRock?
Just flatrockglobal.com. We'll pull up our website. And then from there's 3 different funds that we manage. One does, private credit loans directly. Another fund does CLO double Bs, and a third fund does CLO equity. And then across these three funds, we manage $1.5 billion today.
1.5 billion. That's great. And of course, if anybody is interested listening, you can always reach out to myself, who's an RIA, and I'd be happy to provide that information as well. So thank you so much, Shiloh, for joining us. Is there one last piece of advice you'd like to give to the listeners today?
I think this was really thorough, Richard, and it's great to come on your podcast, and just really, it's an honor, and enjoyed, thought they were great questions.
Thank you so much. I appreciate that. Well, that's a wrap up today of episode of Enrich Life Podcast. A big thank you to Shiloh Bates for sharing his insights on private credit and the CLO and how that can play into your well-diversified investment strategy portfolio. As always, if you enjoyed this episode, please share it with friends, subscribe, and leave a review. It helps others to discover the show and enrich their own financial lives. And until next time, stay informed, stay empowered, and keep enriching your life. Thanks very much, everybody.